Good morning. This is the meeting of the Police and Fire Retirement Plan Commission. A quorum is present. The agenda was posted for public view. Was there any matter of old business to be discussed? Hearing none, we are going to have a review of the investment performance. We will then break into executive session. The executive session will discuss at least two general areas. One being three areas. One being our compliance with the open meeting law. The second being a review of our investment performance. And the third being our use of counsel and having counsel ready to assist us. So with respect to that part of the meeting, they are either exempted under section 3305B5, which is the exemption for considering the investment of public funds, or exemption 7 to consult with counsel to obtain legal advice. And with that, let's have a review of generally how the markets are performing and how we are performing in that market at a high level. And then we will go into executive session to discuss the particulars. With that, Ian, why don't you start and give a review?
I'm sorry. Can somebody contact Ashley and find out where she is? Or maybe she's already on and I can't see her. Ashley Leonard from the Office of Law. They particularly said they wanted a representative here this morning. So Nikki, can you do that? Okay, thank you. Go ahead.
Okay. I displayed on the screen share a update on market performance through the close of business yesterday for principally publicly traded equities and fixed income. And we also are going to go over a review of performance for the retirement plan through June 30. But I think everyone, particularly with the continued improvement in the investment markets, I think everyone would appreciate an update through the most recent days. So there's a lot of numbers on this particular page that I displayed. But if you look under the column that I highlighted, YTD, that is year to date through July 29th. And first of all, just to summarize, and I think I covered this at the last meeting, we had, as a result of the COVID impact, the market was at a high on February 19th of 2020. It subsequently was at a low on March 23rd of 2020. And when you look at the S&P 500 index, the S&P lost just under 34% of its value from February 19 through March 23rd. Since March 23rd, the S&P has had a return of 46.5%, which is a significant recovery from that period of time. And if you now look at the market on the S&P 500 on a year-to-date basis under that year-to-date column, you can see the S&P is actually in positive territory year-to-date with a 1.96% return. So the S&P is representative of principally large company stocks. If you look at smaller stocks, mid-cap stocks, small-cap stocks as represented by the S&P 400 and S&P 600 indices, you can see that those parts of the market continue to be in negative territory. Mid-cap about negative 7.5%, small-cap down about 13.5%. Worthy to note, though, both of those parts of the market, if you look under the period since 3/23, small mid-cap stocks are up almost 56%, and small cap stocks are up almost 48% since the market low. There's been a huge difference in performance between style of management. And this is really important because when we look at performance for the retirement plan in total, we look at performance for the retirement plan relative to core indices. And core indices are indices which embody growth and value. However, the retirement plan has a fair allocation to the value side of the market. And value for the last number of years, and particularly in 2020, has trailed growth. And you can see that reflected in the performance of the Russell 1000 Growth Index, which had a positive return through yesterday of 16% plus. The value index is still in negative territory, negative 11.8%. So when you think of managers like Edgar Lomax, like Cook and Beeler, they have a value orientation. They're buying companies which are cheaper than the index on average, but that has not been the part of the market that has been embraced. The part of the market that has been embraced are the part that has tech names in it, like you often hear in the press referred to as the FANG stocks: Facebook, Amazon, Apple, Netflix, Alphabet. Another one that you could put in here is Microsoft. And these are some of the biggest companies in the equity market, and they have had the most significant performance, and they've driven market performance. So when you look down at the bottom of this page, you look at Facebook with a year-to-date return just under 14%, Amazon with a 64% return, Apple a 30% return, Netflix 49%, Alphabet, which is Google, just under 14%. If you don't own these names in the weight of the market index, many managers failed to keep pace with the benchmarks if they didn't own these larger market cap stocks which have had significant outperformance. There's many, though, who are sort of equating the current environment to like the end of 1999, the dot-com bubble, when the Intels and the Ciscos of the world were going through the roof, selling at very high valuations relative to their earnings. And there's many who believe that, and we saw a similar discrepancy in performance back then of growth to value as we are seeing today. And there's many who are equating today to that 1999 period. So when you look at the international markets are still in negative territory, but they also have done had a nice recovery since the market lows in March. The developed international markets were down about 6.6%, and the emerging markets have actually done better than the developed. They were only down about 1% through the close of business yesterday, and have had roughly a 45% return since March 23rd. The bond market has done very well on an absolute basis, but it's principally limited to investment grade, high quality bonds. And you can see the Barclays Aggregate Index through yesterday had a return of 7.47%. The reason bonds have done so well is that interest rates in general have fallen. And when interest rates drop, bonds go up in price. And the interest rates have dropped because the government has been very accommodative in making money cheap in order to provide stimulus in the current economic environment. So high quality bonds have been the place to be in 2020. But I note that looking forward, the Barclays Aggregate Index, which is the index which is detailed here, has a yield to maturity of about 1.3%, and it has an average maturity of 8 years. So if you hold that index for the next 8 years, you're going to get about a 1.3% return. And that is one of the reasons, like if we look back a couple of years ago, the yield to maturity was like 3%. And that's why many investors gravitated away from high quality bonds and they went into the higher yielding, lower quality part of the credit market in order to reach for additional return, reach for additional yield. And high yield took it on the chin in the drawdown period. You can see under peak to low, high yield lost 20.76%. But since March 23rd, high yield has returned 25%. So it's had a significant recovery, but it is still in negative or just positive territory year to date, up 0.31%. So we've seen a nice recovery in high yield, but you're still basically flat on a year to date basis after the recovery since March 23rd. Is there any questions on this market environment page? No?
But I have a brief one. To what extent do you suppose that all these impressive returns from Amazon, Apple, and all that are as a consequence of the COVID shelter in place? And so this might be just a snapshot in time that won't sustain over any period of time.
I think that there's a high correlation with COVID and the positive price performance of these stocks because, you know, we are using social media more. We're using streaming more. We're like, if you look at every one of them and, you know, looking at my own family, I know that there's a lot of viewing of Facebook and use of Facebook on a day-to-day basis. I see the Amazon truck making deliveries several times a day at where I live. And a number of those packages come to, you know, our house. Apple products, you know, many of us use them on a day-to-day basis. And, you know, I have an Apple Watch on and a Apple phone, and I'm sure many of us have the similar. You know, we watch, I watched Suits on Netflix last night, and I'm sure many of, you know, all of us are using Netflix and other streaming devices. And I can't tell you how many times a day I go to Google and do a search. And so I think there is a correlation between the performance. But when you look at Amazon, Amazon's selling at about 130 times earnings. So you spend, you know, $130 for $1 of earnings when you buy Amazon. And you might say, well, why? You know, why are you willing to pay up so much for $1 of earnings when you buy Amazon? And the reason is that you believe that Amazon is going to continue to sell more and continue to grow faster than the average company out there. But Amazon has to sell a lot more to support, you know, the stock price. And I don't know if any of you, you know, I have CNBC on, and yesterday, Facebook, Amazon, Apple, and Microsoft were up on Capitol Hill testifying or being grilled by both Democrats and Republicans relative to the practices that they follow as companies. And they, you know, these companies are coming under scrutiny in terms of their business practices. And I'm not making an opinion of right or wrong, but the fact is that, you know, I guess the question is, will government scrutiny and potential, I don't know, potential regulation on these companies potentially impact their profitability, and would that potentially hurt their stock price? So I think that, you know, time will tell. But I don't know, Paul, long answer, but yes, I think that there's a correlation with COVID on the price performance of these companies.
Ian,
Yes.
since Chief Stokes is no longer part of this, I may be the lone voice, but once again, I went through the individual performances and I look at this chart, which is quite helpful. And I hope you, if you have sent it to us, I'll have to find it, but if you haven't, I'd really like to get this. It's a very helpful summary tool for me. But, you know, once again, I keep looking at value stocks were supposed to be the ones that helped us through times when we need a lot of management. They haven't done it. And I keep looking at the performance of our holdings versus the indexes, and I still see us underperforming in virtually every case, although I will admit some of our individual holdings that we've looked askance at from time to time, and I won't mention their names in open session, but they actually are performing a little bit better than the indexes right now, at least some of them. But I still wonder if we shouldn't really be giving some serious thought to moving to much more indexing and keep pace with the market instead of continuing to trail it.
And I
Can
think
I
that
say something
discussion
about
we'll
that?
have in closed session.
Okay.
We'll wait for closed session and discuss that.
Okay. So I'm going to make another comment about one asset class, which is not reflected here, but where you have exposure, and that's to real estate, and specifically real estate equity. And so real estate has been a great performer since basically late 2009. And real estate had significant drawdowns after the global financial crisis in 2008. And it was, 2009 was a tough year. But then since 2009, real estate has generated attractive returns. But real estate today has been, I guess, steady, but there's concern looking into the future about real estate because the value of real estate is supported by income at the property level. And the concern is with, industries like office buildings. And, if you look at all of us today, or if you look at corporate America, there's a lot of calls like the one that we're on today taking place where people are operating out of their home and they're not going to their office. And there is a concern about commercial office space in the future. And the demand for that space is going to be, I think, less. And as a result, the income at the property level is going to be less. And so the values of the properties will probably have to be written down because there's going to be less income supporting the current values of those properties. The other area, which is, I think, going to be challenging is retail. And retail is going to be challenging because of the current impact where, there's the consumer, you and I, are not going to the store as much. And so that is going to have an impact on retail, brick and mortar space. And that is going to have an impact on the value of retail properties within investment portfolios. So basically, we've seen slightly negative returns from real estate, but I think it's reasonable to expect that we will see some additional write-downs in the quarters to come as a result of the current economic challenges in certain sectors of the real estate space. Would you like me to go to the June 30 performance report?
Well, Ian, could I ask a real quick question about real estate?
Sure.
On the line item here, the returns, is that representative of valuations of real estate or of income that's produced from the real estate, or both?
So on this particular page, in the public equity market, there are securities called REITs, Real Estate Investment Trusts. And REITs are publicly traded securities. You can go out and buy the REIT sector of the S&P 500 on a minute-to-minute basis, and the underlying collateral is real property. And so now over long periods of time, like 10 years, you should expect the performance of the REIT to be in line with sort of the income and appreciation of the underlying buildings in the REIT. But over the short term, REITs trade like small and mid cap equities. And so when you look over, I'm just going to highlight a couple numbers here. Right here, when you look at from peak to low, the REIT sector of the S&P 500 index was down 37% from February 19 to March 23rd. And since March 23rd, the REIT sector was up 44.6%. And so you might say like, well, okay, so what's the underlying collateral? It's buildings. And so you're telling me that the buildings went down by 37% and then they went up by 45%? No, it's the value of the REIT stock, which is driven by supply and demand features. That's driven by investors who, if there's more investors selling than buying, price goes down. If there's more investors buying than selling, price goes up. So the laws of supply and demand drive the publicly traded sector of the real estate market. I think, Paul, in answer to your question, the performance there is more a supply and demand driven factor as opposed to the value of the underlying properties.
But the underlying property still acts as collateral for that. So is there a
Right.
safety aspect to those stocks?
Over the long term, I believe that the performance of the REIT should be in line. Like when you look at the 10-year return for REITs at about 11.25%, that is the type of return that we've seen from real estate equity. So I think that is, more in line. Like right now, though, the expectation for real estate based upon income of, let's say, like 4% and maybe appreciation of 1 to 2%, you should probably have a 5 to 6% expectation looking forward for the next 5-6 years. I think if we're sitting here 5-6 years from now, we should see that 5-6% return, but you're going to get a lot of volatility in between because of the ability to trade those publicly traded real estate securities on a minute-to-minute basis over the course of the day.
My question was more, is the underlying asset a security that, say, you wouldn't have with maybe Netflix? I mean, Netflix, well, maybe Netflix isn't a good example, but a company that's more name brand driven as opposed to actual physical assets behind the stock. Is there any security aspect to owning the real estate stocks, the REITs?
I see what you're saying. I think what you're saying is that there's more brick and mortar collateral, like you've got a real asset underlying the REIT security, and which is true, but your performance ultimately is going to be driven by the performance of that underlying collateral. And so like in 2009, and I hope we don't have a similar type of environment, but in 2009, real estate equity, that the real brick and mortar, like the Trumbull property type fund, they were down 30 to 40%. And I think that is the concern. So you could have a significant downdraft in the value of real property as a result of the challenges in the real estate market. But if people are still at home, streaming on Netflix, there's a good possibility that Netflix will continue to do well because the demand for Netflix versus the less demand for real estate. So no, I don't think you can say that simply because there's bricks and mortar in real estate that it's a more secure investment than something like Netflix, which is a technology-based company. And I guess the underlying collateral of Netflix are us who stream videos on a nightly basis. I don't know if that helps.
It does, yeah.
So Ian, what is driving the large increase in valuations since 323? Is there a lot of inflow of cash chasing these equities that's driving up the stock prices since the low of 323?
Sure. So what has driven the market are what I refer to as technical factors versus fundamentals. Conceptually, over long periods of time, fundamentals should drive returns, and fundamentals are simply, people going out and buying goods and services and supporting companies, and companies being profitable because the consumer is out actively participating in the economy. And what's sort of ironic is that, we've had this recovery in a period where fundamentals have been atrocious because none of us are out participating in the economy. But these stocks and the market, principally, large company stocks, but all companies have recovered substantially. And ultimately, the market in public equities is driven most simply by supply and demand. And there's been more demand for companies since March 23rd, which has driven up their price. The factors that have driven the demand are the government being stimulative and throwing a tremendous amount of money at the economy. And you might hear in the press a term called "don't fight the Fed," where when you look at the past, when the government has been accommodative, and when I say accommodative, they have kept interest rates low, they've bought back bonds in the debt market to keep money cheap. They have implemented stimulus packages so that consumers that have been laid off, there's additional benefits through unemployment that has basically put money in the pockets of consumers to continue to pay for groceries and to continue to pay for Netflix and Amazon purchases. And that stimulative impact has had a tremendous impact on the psyche of investors. And basically, the market is often a forecaster of the future. And so even though fundamentals stink today, the market has performed well because there's a belief that the economy will eventually get better as a result of these stimulative factors. There's also been a reaction on the psyche of investors whenever there's been favorable news about, let's say, remedies and treatments, vaccines. Whenever there's positive discussion that things are going to get better, like reopenings, the market has traded up. So that doesn't mean things are better. And what's sort of ironic is that, over the last month, we've seen an increase in cases. We've seen, like I live in New York, and New York's doing well, but Florida and Texas and California are doing horrible. But the market continues to go up in the face of, increases in the daily reporting of cases. It's sort of ironic because if you go back 2 months ago, the market was going up when we had fewer deaths and we had fewer reported cases in New York. Now the market is going up when Chairman Powell gets on, and Chairman Powell says the government will continue to be supportive in all aspects of the economic recovery. And that has had a positive impact on investor psyche, on that demand factor, because the only reason stocks have gone up is because people are willing to buy them for a higher price, and that has driven the price up. Doesn't make conceptual sense, but that's what's driven the market. Does that help, David?
Yes, yes, very
And-
much. Thank you.
It's the hard part is the logic of it. Like, why has the market gone up when things are so poor? And that is what's hard for people to get their heads around. It's also, though, a reason why there's a lot of tough calls back in late March. What should we do? And people were scared, and should we get out of the market? And I fell back on sort of institutional conventional guidance, where you don't try to time the market, because the market is not always logical. And so, I sort of get tired of the stay the course term, but a lot of clients were told to stay the course if their goals and objectives, their liquidity needs, their time horizon, and their risk tolerance hadn't changed. The guidance is stay the course, because long term, I think you'll do fine. And it's also really hard to time the market. And I have 15 clients. I have one client that ran for the hills, and they didn't care what I had to say. They basically went, they got out of the equity market. And the 14 other clients stayed the course, and they did better because of it. The other client, they're not that bad, but they would have done 3% better if they had stayed the course. But they couldn't deal with the volatility and the uncertainty. The hard part today is staying. I'm continuing to stay the course, but it seems like there's a lot of clouds on the horizon, because it doesn't seem like things are going to get better anytime soon. Any other questions, comments?
Concluding that overview, let's go into closed sessions, and we'll deal with those portions of the minutes, or those portions of the meeting that have been designated for closed session.